I will tell you, I've gone bankrupt twice doing futures and options. The fact of the matter is that investing is more about behavior than knowledge. First of all, you must get medical insurance from that very first salary or health insurance. Because if you haven't taken medical or health insurance, that itself won't let you stay disciplined in your investments. That 80% of your returns were made just by staying disciplined. 20% is my knowledge, because of which we might have beaten the index. If you are able to control your behavior, you are going to be able to beat the most disciplined or the most sophisticated investors in the money market, Dalal Street, Wall Street. All you need to do to be able to beat those guys is discipline.
In investing, timing definitely makes headlines, but wealth is built through temperament. Markets reward discipline, punish greed, and expose those who chase noise instead of knowledge. Welcome to Market Pillars Uncovered, where we decode the leaders, philosophies, and frameworks shaping India's financial future. Our guest today is not just a wealth manager, but a thought leader who predicted the Franklin Templeton crisis before it unfolded. LinkedIn top voice, TEDx speaker, and a respected market voice with over 500 television appearances. Joining us today is Mr. Kirttan Shah, founder and CEO of Truvanta Wealth, a firm built on integrity, intellect, and a strict client-first philosophy. Through Truvanta Wealth and FPA EduTech, he is redefining how UHNIs, HNIs, and corporate treasuries view wealth. Not just from the perspective of returns, but from the perspective of responsibility, risk management, and legacy creation. In this episode, we will explore India's wealth management evolution towards 2030. Lessons learned from the Franklin Templeton debt crisis. Why risk management is more important than investment management. The truth about buy and forget investing. And that one habit that separates serious investors from speculators. Kirttan, welcome to Money TV.
Thank you for having me.
So, before we get into the discussion, let's go back a few years, let's dial back. First came COVID, and then in 2022, when markets started to stabilize a bit, we then saw a lot of geopolitical tension, which continues even now, in one way or another, right? There is a lot of uncertainty. But one thing that has emerged is that financial literacy is a lot more prevalent, and many people, during COVID, started their investing journey. So, the ecosystem that you see right now, the retail landscape, the wealth management landscape, what do you make of it?
I think India is in a bright spot, and I'll tell you why. If you look globally, if I'm not wrong with the numbers, in the US, perhaps upwards of 35 to 40% of the population invests in capital markets, directly or indirectly. In India, if you remove the duplicates from that number and remove multiple accounts, then it's close to 5% for India. With only less than 5% of India investing, even then, if you look at the DII flows, you will understand how big a base it has given to the capital markets. I still remember 2008, which were the early days of my career. When the market crashed because of the Lehman Brothers crisis, Nifty, I think, if I'm not wrong, was down 65 to 67%. At that time, I asked my senior why the markets were falling so much. And my senior told me then that FIIs had pulled out $4 billion of investment from India, which is why the market fell 67%. If I'm not wrong, the rupee at that time was around 45 to 48. So 4 billion would have been roughly 16 to 20,000 crore rupees. Today, the monthly SIP book itself is 30,000 crore rupees.
Yeah.
So, I think specifically after 2020 and COVID, literacy has significantly gone up because people had time. They didn't know what to do. markets were the only probable option where they could spend some time. And I think that has somewhat. It's become an opportunity for the Indian domestic markets. Because if the 2020 COVID hadn't happened, I think literacy would have been even lower and market participation would have been less too. And because of that, the market impact of foreigners buying and selling would be much higher. So I feel that thanks to 2020, literacy in India has increased a lot. Still, we are very small as a percentage of the population investing. But if even in such a small population, there's an SIP book of 30,000 crores, I can only imagine positively that if this becomes 10% or 15% of the population, then how big a base and how much support the market will get. And which is why the wealth management space, in my is expected to do very well in the decade or so to come. Because all these people who are coming into the markets, I think all the people who came after 2020, from 2020 to 2024, it was a one-way linear rally. But people like you and me who have spent time in the market, they already know that markets are not linear. That's why you get probably more returns than NFT, because it's and only if you stay through the volatility will you be able to make those returns. But these new investors who came in between 2020 and 2024, they hadn't seen such a period or phase at all. So they felt that putting money in the market and making money is very easy. I think it was only between October 2024 and March 25, when the markets actually fell, that people realized that making money in the market isn't that easy. And we've seen over the last 18 months that the markets have actually behaved the way they truly should have.
In fact, you were also credited with predicting the Franklin Templeton crisis, which was again a black swan event of sorts for the markets. So did you spot any such signals at that time? So if you could share with our viewers, typically when any financial crisis or such an environment starts to shape up or a bubble is seen building up, then what are typically the signals or factors that investors should also keep in mind going forward?
In all honesty, if I have to answer this question for you, if the market already knows about something, it cannot result in such a large fall. Right, because if the market knows, everyone knows about it and it's already priced in. So before I get to Franklin, let's talk about the current case. There are three situations. People are talking today about how these might cause the markets to fall. Right, first is geopolitics. We all know what's happening globally. Because we all know, I think most of this is priced in. Right, second is probably the US AI bubble. That's another data point everyone in the world is talking about, that it might cause global markets to go into a turmoil. If I just quote the last quarter's numbers for Nvidia that came out 2 weeks before we are recording this, it was at a record $60 billion of profit for the quarter. I think Nvidia has never seen these kinds of profits. Of course, you and I can keep arguing that it's just money circulation. They're putting money into OpenAI. OpenAI is buying their chips and all that. But at this point in time, it doesn't look like this is going to end anytime soon. Third is Japanese yields or the yen carry trade. I think 3 months ago when we were having this discussion, the Japanese 10-year was at 2.35, today it's at 2.1. If the yields had gone up, it would have been a problem, but they've actually fallen. So there are 3 known factors in the market based on which the market is saying a huge crash will come. All 3 situations seem known to the market, and because of them, a crash definitely won't happen.
That's already priced in.
It's largely priced in. I mean, I don't think the market will fall because of this. What could cause it to fall? I think it's an unknown factor that you and I don't know about.
So how will you spot it? How did you spot Franklin? What were the signals you saw?
So, Franklin and the answer I'm about to give you are very similar. Let me help you understand what happened with Franklin. Yes Bank, Vodafone, LNFS, DHFL, all these bonds were largely AA+ or AAA rated in the market. This means that, theoretically, they were the best priced or had the best credit ratings. In the market, you don't expect these bonds to default. Of course, AAA doesn't mean it's default risk-free. But it means the probability of default is very low. But you suddenly start seeing that bonds like DHFL and LNFS from a AAA rating became default overnight. And what did Franklin do as a fund house? Franklin as a fund house was extremely popular because it took credit bets in its bond portfolio. What does credit bets mean? That when all AMCAs invested in AAA bonds, Franklin typically didn't invest in AAA bonds. It invested a bit in AA-, a plus, a minus bonds because when you invest in these bonds, you can easily generate to 2.5% more return than AAA rated bonds. Okay. And it has been doing this for years, and their fund manager was credited to be among the best in the fixed income space. Now what happened is when your AAA bond defaults overnight, or not just one case but many such cases happen, then liquidity gets squeezed in the market. And liquidity being squeezed means that your A+ and a minus bonds didn't have liquidity anyway. So it's not like the stock market where if you want to sell Vodafone stock hypothetically, you pressed a button and the stock was sold. In the fixed income market, OTC trades still happen, which means your trader will call another trader and ask, I want to sell a 5 crore bond, will you buy it, tell me the price, and then they do the transaction. Imagine in such a situation if AAA bonds are defaulting overnight, who will buy your A+, A- which doesn't have liquidity anyway? So suddenly, because you had invested in credit risk papers and the liquidity in them dried up. Now, if you're facing redemption pressure because everyone in the market is hearing that the bond is defaulting, you'd want to redeem, so how will you provide liquidity? So you immediately liquidated all your government bond papers that you had invested in, which were somewhat liquid treasury bonds. But after that liquidation, when you were left with only credit-rated bonds and the liquidity pressure continued, then how will you be able to service your redemption pressure? That is what went wrong. They could not service and they had to then stop. Because if they decided to sell at whatever price was available in A+ and a minus, these funds would have been down 30 to 40%. And we kind of understood it a month before the fact sheet came out. Because when we looked at, sorry the answer went on pretty long, but I'm just trying to explain what happened. We looked at the fact sheet a month before things went wrong, and on the fact sheet there is something called CBLO, collateralized borrowing and lending obligations, which was close to minus 17%. It simply means that the fund faced redemption pressure. The fund borrowed 17% of the AUM from the market to meet that redemption pressure. That was a trigger, like, why is it borrowing from the market to meet redemptions? You should be able to sell the bonds, right? And then we deep dived to understand what was going on. Now, why did I give you this background? Because currently, what you see happening in the US, which not a lot of people are talking about, is something very similar in the credit space. If I am not wrong with the name of the fund, there is a fund in the US called Blue Owl. It is a $3 billion credit fund. For the first time, they have stopped their redemptions. And 2 or 3 more such instances are happening in the US credit market where the credit market is not acting very normal.
If this goes down, then it could have ripple effects globally as well.
Absolutely, 100%. Because, you see, in capital markets, as people often say, your fixed income market provides the early signs for global turmoil. So, if you want to find a problem in anything, or see if a problem is occurring or not, you look at that market's fixed income market because it gives you the signal first. It is a front-running signal. While I am not saying this is what is going to happen, I am just trying to answer your question.
something is brewing.
The three known things, the Japanese yen carry trade, the AI story, and geopolitics, people know about these. But people don't know about the credit situation brewing in the US, so we should pay attention there.
That's a very interesting thought that you've given to our viewers. Because everyone is chasing 1, 2, 3 theories and developments, while the actual action might be happening somewhere else, because I think, some potential turmoil could happen from an unknown place. But let's talk about what you said at the beginning, that India is a very, poised market for wealth management. You also shared the mutual fund numbers with us. There is one thing which you have often said, that the buy and forget strategy is not something you endorse or subscribe to, and in fact, you've called it a failed strategy. So now, in this market where passive investing is growing so much, retail investors are moving towards mutual funds, money managers, and several other avenues. How can investors actively track their portfolio and investments? How can they track it according to long-term discipline? Because once you've given your money to a fund or a money manager, it's more likely that you'll forget or you won't track it that actively, because you've already trusted someone and given them that money.
I think I'll split that into 2 or 3 points. First, I still completely vouch for the same argument that buy and hold is a failed strategy. If at all you think you can't do this, then you should manage your money passively. Put it in the index will automatically do that job for you. It will remove the stocks that aren't performing and add the ones that are. It's a brilliant momentum strategy. Just quietly put your money in the index, and it will keep moving up and down, back and forth on its own. But when someone invests in the Indian market, the probable thought process is that I want returns higher than the index. So to get higher returns than the index, you invest in active strategies, and in active, buy and hold is a failed strategy. Why? I'm not saying this because fund managers aren't great. I'm saying this because so many changes keep happening that if you can't adapt to those changes and don't pay attention, it will be counterproductive for you. Like, say for example, you put money into a mutual fund today after looking at the returns of the last 3 years. I'm not saying that's a great strategy, it's the worst strategy.
And that's actually a very common mistake.
The worst strategy, right? But hypothetically, for this discussion, you invested money in a fund after seeing the returns of the last 3 years, and now you thought that you're taken care of, you're a long-term investor, and you'll stay invested for 10 years. But most investors don't even know that after 1.5 or 2 years, that fund manager whose past 3-year returns you looked at before investing has himself changed.
Yeah.
Right? So you may be a great buy and hold investor, but the thesis you had in mind when you gave money to that fund, at least check if that thesis is still continuing today or not. I'll give you another example. SEBI has become extremely vigilant because so much retail money is coming into mutual funds.
Right? And for retail protection, SEBI is taking every possible step. Now, one of the steps that SEBI is taking is to keep a track that is your fund meeting the objective properly or not? This means 10 years ago, hypothetically, let's say you had invested money in a mid-cap fund. In 2018, SEBI brought a new rule which you call mutual fund categorization. At the time that you and I are talking, they revisited that categorization a month back. So now, the money you put in a mid-cap fund 10 years ago, that fund today has perhaps become a large and mid fund. Right? So now, you had invested thinking of it as a mid-cap fund, but its entire objective has changed today. So should you still continue? You will have to revisit and reevaluate this overall thought whether you would want to continue or not, right? So these are some examples where just because you gave the money doesn't mean you'll forget about it. First of all, you have to figure out why you are giving money to a particular fund manager. And if you saw 4 things because of which you are giving money to that fund manager, then you will have to continuously track those 4 things to see if it is still on that similar thought process on which I had given the money. So putting in money and forgetting about it, I think, is not a great idea. If you feel that you might not be able to track it, and which is very normal, right? Because I very firmly believe that whatever you don't understand, you just outsource. So if you don't understand money management, then get somebody on board who can help you do that. Then it becomes their job to track it. So if you can't do it, either go passive or hire someone who can do this on your behalf. But thinking that I have put in the money and I am a long-term investor, now I don't need to look at it, is not the right way in my opinion.
You know, if I have to ask you, between risk management and investment management, what is your priority or what do you emphasize more on? What would you say?
I think for me, always risk management has been far greater in terms of importance than investment management. And I'll explain that to you in 2 contexts. First, let me explain that to you in the market context. You put 100 rupees in a fund, 100 rupees became 50 rupees because the market fell. Now when 100 rupees became 50 rupees, the market fell 50%. But now for this 50 rupees to become the original 100 rupees again, the market will have to go up 100%. So for you to be where you were, the fund will have to generate a 100% return. Imagine that versus another fund where you had taken care of downside protection while investing and that 100 rupees became 75. Now, if the market gives a 100% return, this fund will become 150, while you will only just get back to 100. Right? So that's a great advantage that you bring on board when you work on the downside limitation. Now, that was relevant to the stock market. Let me give you an example relevant to financial planning. All of us, you and me, anybody who is on the internet today, we have heard this, that start investing early, compounding is the 8th wonder of the world and all of that. Don't waste time. As soon as the first salary comes, invest the first bit of money. I think that is a failed strategy again, and I will explain to you why. Let's say you are 21 or 23, 24 when you get your first salary. You started investing 5,000 rupees from your salary every month in an SIP. Suppose after 5 years, you had invested 3 lakh rupees in your portfolio and it became 5 lakh rupees because of the returns. And now a medical emergency occurs in your family. Given the way medical expenses are in India, your 5 lakh rupees will fall very short even to fulfill the medical requirement at your place. So what happened? You started early investing. You even maintained discipline for 5 years of investing, but did that money help you when you needed it? The point that I am trying to make is that when you get your first salary, first of all, you have to take medical insurance from that first salary. Or take health insurance, because if you haven't taken medical or health insurance, then that itself won't let you maintain discipline in your investment. You withdrew 5 lakhs, didn't you? Because a medical emergency occurred at home. So risk management is extremely important. Before 2020, when we were telling our clients that you should have an emergency corpus, they used to laugh. Today, you and I both know that if the job is gone, how will I continue the SIP for 6 months? I will dip into the investments that I have made. So where did your discipline go? So I think risk management is extremely important. You cover risk management first, then do investing, then you will be able to stay disciplined and you won't disturb your investment.
You know, in your firm Truvanta, you deal with ultra HNIs, NRIs, everyone. So when you have to manage large mandates or multi-asset portfolios, is it the same approach that you have? How do you advise the clients?
I think it's a very interesting question, and I'll tell you why I was smiling when you asked this. The problem with a lot of ultra HNI and HNI clients is that they want coffee table discussions. And I'm hoping that none of my clients are watching this, but they want coffee table discussions. They want to be able to show off when they are sitting with their peer group that my fund manager bought this stock or I have invested in this startup. I keep telling them, the simpler you keep your investments, the more money you will actually make. Right? The more complicated investment strategies you apply to your investing, only people like us will make more money and you will never make any money. Given a choice, and if it were left to me, I would really want to keep their investments extremely simple. Because we have easily been able to beat the markets by 4 to 5% in general just by doing mutual fund investing. Why should I put their money into complicated investment strategies, block their money, make them pay higher fees, and then it does not turn out to be as good as I was expecting as an output in terms of risk return? So, given an option, I would want to keep it absolutely plain and simple. But like I said, there are clients who do not like plain vanilla, simple strategies, right? They think a mutual fund is a commodity, and they will not be able to discuss this investment in their peer group. They think their driver is also investing in mutual funds and they are also doing the same, so where is the novelty factor? So we try and keep alternatives as low as possible, but in some cases we have to because there is a client requirement.
Interesting. So, talk to us about your journey so far. You have worked in NBFCs, you have worked in the markets, and now you are leading Truvanta. So tell us about one, maybe, defining point in your journey as someone who is a market participant and also advises people. What has been the most defining moment in your professional journey?
I think I'm not sure if this will really answer the question that you are looking to get from me, but I will tell you, I have gone bankrupt twice doing futures and options. And I can tell you with utmost confidence that if you and I start talking derivatives right now, I will be able to answer the most complicated question that you might have in terms of derivatives because I understand derivatives that deeply. And which is why I took those large positions whenever I did. After 18 or 19 years in finance and with my educational background, anyone, including me, would have thought that I understand finance, right? But the fact of the matter is that investing is more about behavior than knowledge. And I keep telling this to a lot of people that I meet, that over a longer period of time, if you evaluate your returns on the portfolio, you will realize that 80% of your return came just from being disciplined. 20% is my knowledge, because of which we might have beaten the index. So I think if I have to share my one learning from an investment management personnel in this business, I think it is all about behavior. If you are able to control your behavior, you are going to be able to beat the most disciplined or the most sophisticated investors in the money market. Dalal Street, Wall Street. All you need to do to be able to beat those guys is discipline. And that's my learning or a defining moment, if I can say, in my career. While I've managed corporate investments, HNI money, I think investment management as an investor and as somebody who's managing investment is all behavioral management game. Knowledge is a very small part of this entire ecosystem.
And you work so extensively in financial literacy, financial education, and you do a lot of public speaking. So is there something you've learned from an investor or from, people you meet? Any interesting thing about investing, about the way you work?
I'm not sure if it is about the way I work, but I will tell you one very interesting lesson that I've learned. From Radhika Gupta, Edelweiss CEO, MF CEO. And she said very interestingly that, irrespective of whether how good or how bad you are, right? You should be a great storyteller. You should be able to communicate really well. Because like I said, I firmly believe that this business of investing, or me as an individual investor, it's a behavioral game, right? Now let's say if hypothetically we manage 300 families today that I talked to you of, and then there is a war happening. And like you rightly said, most of these guys have never seen a war in the past and they don't know how markets react. How do you make sure that they don't withdraw the investments and still continue to stay invested? Because 80% is your discipline. So I think that art of you to be able to communicate that boss, why you need to stay invested, this is a daily thing, it will keep happening, don't bother. If you have more money, invest. I think that's a very interesting learning that I've got from her, that learn how to tell stories. Because stories relate to people immediately, and complex discussions are not something that everybody on the ground will be able to relate to what you are saying. So I think, if there is something that I've learned, I think that is the art of storytelling. Or I would not say I've learned, I'm trying to learn is the art of storytelling.
Wonderful. Thank you so much. Today you have also with us in great detail and very effectively, you've shared all your ideas and whatever learnings you've had and your observations too. Thank you once again for joining us on Money TV.
I'm so glad that you all had me, and I hope for people who are watching us, they will have something to take away. Thank you.
Absolutely. Thank you. That's all for this episode of Market Pillars Uncovered. If today's conversation made you think differently about risk, discipline, and wealth, then please like, share, and subscribe to Money TV. Because here, we don't chase the noise, we uncover wisdom, decode strategy, and help you build wealth in a responsible way. So until next time, invest smart and stay informed.